and welcome to our final webinar of the year, Customer Experience in the Age of Consumer Duty, in partnership with Trustpilot. I'm Dan King from Insurance Data Lab, and before I introduce today's panelists, I'm going to ask Matt Scott to reveal some of the key findings from our new Customer Experience Report to be published later this week. Hi, Matt. So what are the headline findings?
Hi, Dan. Thanks for that. So we've once again looked at performance across 4 key pillars. So that's claims, customer satisfaction, complaints, and transparency. And the worrying finding is that the average score across these 4 pillars has fallen. So the average rating stood at 69% last year, but that has now fallen to 68%. Now, this might not seem like much of a drop, but the industry really needs to be making strides forwards when it comes to customer experience. So it is a bit of a concern that this isn't happening. And in fact, the only pillar to receive a higher score this year compared to our last report is transparency, which rose 5 percentage points to 71% for the 24 companies in this year's analysis.
The FCA said that complaints performance is going to be one of the key areas it looks at in assessing customer outcomes. Are there any interesting stats you can expand on in that area?
Yeah, so the overwhelming majority of complaints continue to relate to the claims process. Almost 4 out of 5 complaints referred to the Ombudsman relate to the claims process. So that needs to be a real focus for the industry, I think. The companies covered by this research have, in the main, also been reporting relatively high upheld rates, with the FOS finding in favour of the customer in around 28.4% of cases over the second quarter of 2023. And that's up from just over 27% for the companies covered by last year's report. The volume of complaints has also been rising. This year's cohort of companies received an average of 3.96 complaints per 1,000 policies. That's up from 3.42 last year. And some insurers are actually seeing considerably higher numbers than this average as well. The worst performer in the report this year had in excess of 12 complaints per 1,000 policies sold. So that's more than 3 times the average.
Wow, okay. Are there any bright spots to be found?
Yeah, there are. So despite these, headline findings, there are a number of businesses continuing to offer an excellent customer experience. And I'm delighted to reveal that this year we're awarding 6 CX Gold Awards for those businesses that have excelled. The top performing insurer for 2023 is NFU Mutual, with a score of 78%, and that makes it 2 years running that the insurers topped our rankings. Cavea clinched second place this year with a score of 77%, and it's now the only company to have earned 3 CX Gold Awards in a row for every year we've done this research. And then our other Gold Award winners for 2023 are NatWest, HSBC, Santander, and finally Direct Line Group. And if any of this year's winners are interested in using these endorsements, feel free to reach out to me or Dan via email or through our website at insurancedatalab.com. We also offer benchmarking reports to help companies compare the performance of companies across these 4 pillars of performance. So again, reach out if you're interested in finding out more about that.
Brilliant. Thanks, Matt. So I'd now like to introduce today's panel. So please welcome David Williams, Director at Freedom Services Group, a seasoned compliance consultant, Claire Carpenter, and Trustpilot's Senior Partner Manager, Graham Wilkinson. We'd like this session to be as interactive as possible, so please submit any questions or comments you may have, and I'll put as many as possible to our panelists throughout the morning. So to kick things off, David, you've heard Matt say that our research has revealed a slight dip in customer experience over the last year. Why do you think this is, and what's your take on the experience currently on offer from the industry?
Yes, thank you, Dan. I wasn't surprised when I saw the drop. I think, if I'm honest, I thought it would have been a bigger drop. So that's good news. It's not as bad as I thought it was going to be, and that's based on conversations that I'm having with insurers and brokers, and generally they are saying that they're not getting particularly the claim service that they require. In terms of what's causing it, I think we'll go into a number of the potential issues, but I think one of the big ones, just being really simplistically, is that insurers still haven't got their act together post-COVID with remote working. It is really difficult, particularly with larger teams, to get the productivity levels that you need up. And when you talk about larger teams, that's exactly the claim space, particularly in terms of sort of notification. So speaking to people, I know that insurers want to get staff back into the office because they recognise the benefits of team building and training and all those sorts of aspects. But the problem is we have a skills gap. So we have this quandary for an insurer. I was speaking to one of the largest insurers yesterday, and they were saying that they'd announced that people were going to be back in the office 2.5 days a week, but then mysteriously that doesn't get mentioned anymore. I think it's because people are concerned. I mean, there was one story of another financial services company that basically said, right, we want everybody back in the office full time, COVID's over, and they lost something like 75% of their staff. So it's a difficult one, but I do think unfortunately, yes, we are seeing problems with customer experience across the piece, and part of that is definitely due to productivity levels post-COVID.
Okay, thanks. And Graham, Trustpilot has its finger on the pulse of what consumers are thinking. So what are you seeing?
So from a whole, what we're seeing at Trustpilot is growth within our insurance category. So Trustpilot is broken down into specific categories across the board, and we have one specific that houses any businesses that are designated as insurance. And as of what I mean by growth within that category is that we've seen a higher number of reviews, and we've seen more businesses being reviewed over the period of the last 12 months versus the previous 12 months, which for us is a positive. It basically means that there is more of an appetite for consumers to actually give their feedback. And there is more of an appetite for businesses to ask for that feedback. So more insurance companies are looking to third-party review platforms, Trustpilot being one of them, as that sort of vehicle to gather customer feedback. So instead, maybe like 15, 20 years ago, when people were utilizing things like focus groups or sending out surveys, they're now looking at third-party review platforms for an easier way to garner consumer sentiment. And Trustpilot continues to grow in that sphere. In terms of the actual sentiment that we're seeing, it's quite interesting that we have over 1,800 insurance businesses reviewed in that category. 50% of them, so Trustpilot is done on a score of out of 5 to 1 decimal place. 50% of the organizations that we have reviewed on Trustpilot are 4.5 stars and above, which is absolutely phenomenal. So there is a lot of positive sentiment out there about insurance companies. However, 22% are below 3 stars, which is quite alarming, I suppose, but it does mean, sort of says to me that there's not much of a middle ground. It says a lot of the feedback that people are giving is either, hey, we think you're really good, we've really enjoyed this part of your service, or we think you're really bad. There doesn't seem to be a lot of like middle ground there at all, really. But on a whole, what we're seeing is like I said, a bigger appetite, could be driven by consumer duty, a bigger appetite for people to actually review their insurance providers, but also a bigger appetite for insurance providers to say, hey, look, we want your feedback. We're going to ask for your feedback. And they're becoming more proactive on that front. So yeah, overall, I'd say it's growing on our platform. And what that's driven by, I'm sure we'll get into in the next 45 minutes.
Okay, thank you, Graham. And Claire, do you think the industry is doing enough to monitor and benchmark performance in order to highlight areas for improvement?
I think I would say it's probably overall no. And I'm seeing a differential between insurers that manage their own claims and manage a lot of their own services compared to those that delegate. I think there's quite a big gap around the oversight of those delegations. I think from a value measures perspective, having supported some of the sort of larger insurers to develop those value measures the previous year, I think the DSEO letters that have come out of GAP and highlighting some of those value elements have been a bit of a surprise to firms. So I'm starting to see them sort of take a closer look at that data and sort of panic a little bit more. But the delegation side of it is very much an issue. I'm seeing that insurers really struggling to get things like benchmarking and NPS scores and all of that stuff through from TPAs, claiming claims inflation and claiming overheads, and that particularly is becoming an issue when you view it in the round of fair value. So I definitely think more should be done. But I do think I can see some firms trying harder than others.
Okay. And one of the things we noticed in our research was a very high upheld rate when it comes to complaints referred to the Ombudsman, with more than a third being found in favour of the customer. David, what do you think the issue is here?
I think there's two sides to it. So in an attempt to be balanced, I'll do both bits. So on one side, you're bearing in mind that these decisions are published, so you can read through them and see what decisions are being made across the market. I get the impression that the Ombudsman is seeing itself even more as a consumer champion. And frankly, some of the decisions don't make legal sense. But then maybe it is less about legal sense and more about customer expectations. The problem there is that customer expectations in arrears, when something's happened, are often much higher than they probably were in reality at the time the policy was taken out. But the problem for insurers is if you're not taking a legal approach and exclusions or limitations aren't being allowed to be applied, what does that do? Do insurers need to be thinking about sort of exclusion-free policies? And the other sort of potential negative, I suppose, is we do have to recognise that we're in a cost of living crisis, and at those times we know that there's an increase in fraud, and people do see that sometimes they can get success just by shouting a lot, and there still is a serious problem with compensation culture in the UK. Now that's one side of it. The other side, I genuinely get probably more disappointed than on anything else when I see a high upheld rate, because it's a massive failing on the part of insurers. They ought to know what an ombudsman's decision is going to be, and they should be adapting their processes, their practices, their claims best practice guides, and responding accordingly. I think one of the issues is, again, it sort of comes back to, maybe problems with productivity. We're very process driven, and maybe things do just get stuck in a process rather than somebody with a bit of experience looking and saying, well, we need to just deal with this claim. But as I say, insurers should be changing their practices. There's a sort of unwritten rule that if the Ombudsman finds against you on a particular point 3 times, you pay all those going forward. And certainly with the company I've been involved with, we try and stop it before it got to there and sort of change our practices. I do think, however, that transparency is key, because people, if they fully understand the limitations in cover, for instance, then they potentially wouldn't be complaining, wouldn't be going to the Ombudsman. And that was one of the real positives in your report, that transparency is up. So hopefully we're at the start of things turning around in this regard, and insurers are very much focusing on increased transparency to help with expectations.
Yeah, thank you. Claire, you were nodding away there. Is there anything you wanted to add to that?
Yeah, I can agree more with David. And I think one of the things, and I focus my majority of the time on the sort of delegated space. I'm seeing TPAs in their own right, just moving along, doing the best they can. But there's no broader perspective on, customer outcomes. I think there's a gap between people understanding what customer outcomes are throughout the chain. And I'm not seeing insurers drive that change, with minimum standards or kind of, guidance and training for TPAs. And I think I say this all the time, but there's a mismatch between the underwriter writing the policy wording and the TPA not understanding how that was intended to be delivered. And I think that's a consistent issue, and particularly around claims upheld rates. David, I couldn't agree more. It's a failing in the process and in the customer outcomes, because when I see some of these cases come back, it's infuriating, because actually when you look at it, you take a step back and have a look at it, and it should be part of your process. There was no reason that should have gone to the FUS in the first place. That should have been addressed more promptly. And I'm not seeing insurers take hold of that as well as they should do, and it's quite disappointing. And I think there is a difference, though, in what we would call capacity insurers and the kind of standard insurers, where capacity insurers have the kind of step back entirely and leave it to MGAs and TPAs. And I think because of the length of that chain, the dilution of processes and customer outcomes is quite transparent.
Okay, thank you. And staying with you, Claire, obviously you're an expert when it comes to consumer duty.
Apparently so.
And the new regulations were obviously brought in to help improve customer outcomes. Do you think it's kind of having the desired effect?
Not as much as I would have liked. I was quite, been in insurance for 20 odd years now. And I had hoped this was kind of being a turning point for some of the things that I found frustrating throughout those 20 years. I've seen some really fantastic practice from firms. There's one firm really just looking at the design process and how they can consider vulnerable customers and the scenarios about and using data to try and assess what their demographic is. I'm seeing some fantastic stuff. And then they say that scenario analysis about what will happen to those customers in that space. But generally speaking, there's an MI problem, which I say every single time I speak about anything. People are not gathering the right MI, they're not analysing it, and it's not feeding up through the chain to inform decision making. And that's really disappointing, because actually in lots of these places I see wealth of MI, and there's an opportunity, even before you start gathering extra stuff, is to turn some of that data on its head and look at it differently and try and pull some of those metrics together to get a broader perspective. And I think we can see from the Dear CEO letters, which I think we're going on to shortly, but we can see that firms again aren't taking heed of particularly in outcome 1 and 2, which is particularly disappointing and frustrating given it's been in place for insurers for 2 years under GIP. Really not seeing firms do as much in that, and it's a bit disappointing, if I'm honest.
Okay, David, I know you do a lot of work with companies around consumer duty too. What are you seeing, and how do you think the new regulations are impacting customer experience?
Yes, a bit funny, really, isn't it? Because if you think about it, as Claire's been saying, she's been frustrated for 20 years, whatever. A lot of this insurers should have been doing already. So I've heard some people referring to it as, treating the customer fairly with bells on, things like that. And I think there is maybe a bit of confusion as to exactly what consumer duty is. But the reality is, if we're sensible businesses, we've always wanted to, deliver to the customer a fair outcome, because you see sometimes people have a go at insurers and say they're just favouring the shareholder and they've got to make a profit, and therefore they're always trying screw people down on claim settlements. That's absolute rubbish, because the reality is, if you are not delivering what the customer wants, you're going to lose your customers, and therefore you do have to be providing good service and fair value products. So that's been there. I think there's been a lot of panic across the market, partly because people didn't know exactly what they needed to do. Again, we'll probably come back to this, but it's a case of what we got to do. So there's these headline descriptions. People want a template, they want a target, and they're not getting those. So I think it's right that they're not, because it does vary from business to business. I think I'm seeing good things in terms of transparency. I think people have twigged that expected outcomes links directly to what the customer thinks at the time of taking out the policy renewal, that sort of thing. So some really good things in, as I mentioned previously, it's good to see that reflected already in the report. I think the unfortunate side effect, which we often get with regulatory changes, is that I actually think consumer duty, in a way, has caused insurers to deliver worse service for their customers. I may be playing devil's advocate a bit here, but the reality is, if you look, we've had GIP, the General Insurance Pricing Practices, Rules, whatever, and then we've had consumer duty. And what's happened is insurers have said, right, this is the fundamentally most important thing now, because it's focused on the customer, so they're all customer focused. But what they've then done is they pulled massive project teams together, including some really key people off of the front line. So I'm hoping this is just a blip, and they're going to be able to persuade those really good people to go back to the front line, because I think, sadly, insurers certainly, and some of the larger brokers, have been so focused on these quite internally focused projects that they've lost some expertise at the other end. And it's great that they are putting serious people to design processes going forward. But as I say, I just think in the short term, what we've actually seen, it's madness, isn't it? We've had consumer duty, things should be getting better. It's as simple as that. And what does your report say? It's going in the opposite direction, which is very sad.
I think there's an extra bit to add to what you're saying there, David, around the temporary permissions regime. So what we've seen from the FCA reviewing European firms that currently write millions of GWP for consumers in the market, those have now withdrawing those applications, and the FCA have been quite aggressive around value measures and using value measures data to determine the outcomes of some of those branch applications. And what I'm seeing with some firms, I work a lot with MGAs and insurtechs, trying to find a new home for these products, and it has been near on impossible. And the reason is insurers are terrified now to take on particularly some of these more ancillary products, and it's causing what I'm coining a capacity crunch within the market. And what that's doing, it also, and some of the firms I've been involved in some of these horrifically large projects on Consumer Duty, and people are templating. I'm seeing the same wording from one product to the next. There is not a lot of kind of unique thought going into this, and using the data in order to inform actions. Probably reviewed, I would say, about 100 fair value assessments, and hardly any of them have got actions in order to improve the value of the products, or review the data, claims data or claims to clearance data to enhance that. And it's disappointing. I can understand why now insurers are quite concerned about even wanting to write any of this business at all, which shouldn't be the case. If you can get it, you can get it right. There could be a real opportunity for some insurers to pick up this business, doing it right, utilizing data to inform the products.
Yeah, also reflecting back on the comment you made about MI, I didn't mention that, but that's absolutely key in terms of the one thing that I think you can guarantee that the regulator will want to see is every company's Consumer Duty dashboard. And it's disappointing that MI hasn't been instantly available, but is a real positive that those dashboards are now being produced, and they're being discussed at a board level, because that clearly wasn't happening before because the data wasn't always available.
No, and I think that through the TPR, the FCA had got greater visibility through some of these firms and their application about what's happening in the market. So I think it's a bit unfortunate for the rest of the market because of the TPR stuff that's gone on, that the FCA are now seeing even more gaps that they previously wouldn't have had a visibility through a thematic review.
Thanks, guys. So Claire and David, you both mentioned there about MI. I don't know if one of you wants to just kind of maybe give your view as to what type of MI you think companies should be taking kind of more care over and tracking.
Do you want to go, David?
Yeah, I mean, I think some of the things we've mentioned already. So your complaints data is absolutely sort of fundamental. If you're not looking at claims data at board level, complaints data at board level, then you're failing miserably. But I do think sort of satisfaction surveys are another excellent area, because you get more than just a number. So yes, the number's great, but also other comments can, because I do like actions. I think when Claire was talking about some of the sort of product assessments not including any actions, that tells you that people are doing them because they've got to get them done, rather than that they're genuinely looking at the individual products and looking for reasons to improve. What I've always felt you should do is look at complaints data, look at satisfaction survey data and comments on a regular basis, and change your processes and policy wordings as appropriate. So I think it's a case of you can include what you like in the dashboard, because nothing is mandated, but fundamentally you need to be looking at whatever satisfaction measures you can find. So things like Trustpilot, really, really good in that regard. Complaints data, upheld rates, but also fundamental things like declinatures. People talk about the proportion of claims that are paid by insurers and things like that. I think there's a bit of nervousness because it does vary from product to product. And if you have a storm, declinatures increase. Now, the reason for that is storms often reveal leaky old felt on timber roofs that have deteriorated over the years. So I think it is about having an appropriate narrative to go alongside, because then you can have meaningful discussions.
You're absolutely right. It's a balance between qualitative and quantitative data. I like you, I really appreciate the Trustpilot data, because often what that does when I look at that is show up some service risk issues, which is the majority of what customers complain about. You look at home emergency, or you look at ones where there's repairs. So as part of the fair value assessment and as part of monthly conduct MI, always use Trustpilot data. And always, whilst you can't necessarily benchmark it, I consider it more sort of qualitative, because you've got some fantastic insight. And one of the things that I think firms haven't quite picked up on is around vulnerable customers. So I go out and I audit a TPA. So they're very good at flagging the customers vulnerable. What they're not very good at is what the resolution to that is. So I've created some kind of high level resolutions to that, because there's lots of soft skills that people don't even think to record. And so actually there's much better data that we can get through if you just standardize the resolutions for those vulnerable customers. So you can actually see there's probably so much more going, well, I know there's so much more going on to support vulnerable customers that people aren't recording. And it's just trying to find a way to standardize some of the reporting as much as possible, get the quantitative stuff, but as David said, overlay that with a more qualitative narrative and things like Trustpilot and IDL's data. I mean, one of the things that I think you guys are really fantastic at is pulling all, because we can go to one spreadsheet for value measures, we can go onto the FOS website, it's in a completely different format. And I think that's one of the things that IDL does very well, is enable people that are doing product assessments or monthly conduct committees using that data. It's in one place, and it really makes you be able to kind of pull a broader picture together. So yeah, there's lots of improvement, but I don't think it should be that hard.
Yeah, great. Thank you, Claire, and thanks for the plug.
No worries.
So Graham,
I'm not getting a commission, just for
but Graham, David talked there about services like Trustpilot. So turning to you, how can Trustpilot and services like Trustpilot help the industry to better understand customer outcomes and improve the experience on offer?
Well, David, thank you so much for teeing that up. That was a lovely little plug for Trustpilot from both of you there as well. Your check is in the mail. Yeah, most people, when they think of Trustpilot, they just think, well, you do reviews, like what else do you actually do? But in reality, if you look at Trustpilot as like a holistic organization and a tool, you have to focus on the fact that it is a sort of vehicle for continuous improvement. And the cycle that it perpetuates is essentially that a consumer will have a business interaction with an organization, and then after that is completed, you have the ability to ask for a review. And then when you receive the review, the most important aspect that Trustpilot facilitates is what happens after that. Because it's all well and good like collecting positive reviews and negative reviews, but what you do with those reviews dictates and can dictate how to sort of drive change within an organization. So the cycle should always be, and whenever we look at the benchmark the best organizations who utilize Trustpilot as a platform, and this goes for all third-party review platforms as well, we aren't the only one, but it's about how you analyze the review. So read the review, understand the review, and there's so many tools, like data-driven tools that we have in the back end of Trustpilot and reports that are available to you, even on the free version of Trustpilot, that allow you to really dive into the sentiment that you pick up within a review. Because don't forget, a review isn't always just positive or negative. David, you mentioned about actually, like even from surveys, it's the comments that are the most important thing. So yeah, you may well get 4 out of 5, but what is most important and what is really going to drive change within an organization is what the consumer is actually saying. And I suppose this is a really good measuring stick for consumer duty. And this is how Trustpilot sort of ties into it, really, because essentially what you can then do is you can pick up sentiment. So we have like AI-driven technology that can actually take a look at a review, and a review may say, like if I take an example of a bog standard like e-commerce review, it could say, delivery was really good. We were happy with the price, but the quality of the product wasn't that good. You've got like 3 sentiments within there, even though that's only a matching to 1 score. There's a lot more that you can really read into it. And that's a very, very high level. And with insurance, people will go into a lot more insight into their experience. And it's all about digging out as much information from that as possible. And that's what Trustpilot can provide as a vehicle for change. So like I said, really good organizations who utilize our platform, they have people whose job it is to look after their reviews and to report on them on a weekly basis. And whether that's into like a specific team or into the board, we like to say that Trustpilot enables people to see problems before they become problems. because as soon as your customers start talking about this or that, and it's not just a negative thing, it's about what you're doing well, it then becomes a situation of somebody could go into a board meeting and say, hey, look, this is what our consumers are saying. And if consumer duty is all about trying to simplify things or satisfy to a very high level description of consumer duty, Trustpilot is a really good measuring stick for that. It's not the only one that you should use, but it definitely is a really good supportive like yardstick for how your consumers are feeling about you as an organization.
Great, thank you, Graham. Actually, staying with you, Graham, because we've actually had a question come in, and quite a few questions have come in. So thank you, everybody, and do keep firing them in. I will try and get to them during the session. But one for you, Graham, has come from Sean Milley, and I know you may not have the data to hand, so no worries if you can't answer it too fully. But Sean's asked if there's any kind of takeaways or comparisons between kind of how insurers are faring on Trustpilot against other categories, so the related categories of kind of industry sectors, and whether there's anything particularly relevant to say about that, in your opinion.
Well, so this is quite interesting, actually, because most people, when they think of reviews, they think of standard like e-commerce brands and e-commerce activities. And I would say what's quite interesting about insurance, and this is more of like a strategic decision for insurance companies, is when do you ask for a review? And the reason why I raise that is because, let's say, if you put yourself in the shoes of somebody who's gone to buy a new t-shirt, and you go online and you order the new t-shirt arrives, you're probably going to wear it within a couple of days. That's normal activity would be, you probably wear it in a couple of days, and then you're in a position to leave an honest review. With insurance, you purchase an insurance policy. So you go through the whole process of purchasing an insurance policy. When does the insurance company then ask for that review? Because there's two trains of thought. And one of them could be, if I ask for that if I ask for that review right now, essentially all people are going to review is on the purchasing process and probably the price. However, if you wait for somebody to make a claim, because you don't need to ask for the review instantaneously, there's no laws around that. You can ask for it whenever you like. We have quite strategic, a really good example is somebody who may sell a lawnmower over wintertime isn't going to ask for a review until the end of May or something like that, because that's when you know you're going to get your honest feedback. So insurance companies are in quite a unique position. I'd say the one category that it compares to is legal, because legal and insurance have always been quite, I suppose, they've always been a little bit put off by really knowing what their consumers, what their customers are saying about them. But I think they're slowly starting to change, and people are actually seeing it as a positive thing to understand that aspect of feedback. But there are nuances, and this goes for all categories across Trustpilot. There are all nuances about how you actually get that feedback at the right time, but also you weigh up strategically when is the best time to try and get as much good feedback as possible. So for an insurance company, it's an interesting one. People will have different opinions on it. But yeah, I'd say the legal category that we have is the one that is quite similar to insurance in terms of a little bit of a slower rate of adoption, but really starting to pick up now.
Great, interesting. Thank you very much for that, Graham. So staying on the topic of regulation, David mentioned it earlier, but the FCA sent out a Dear CEO letter, and I think, Claire, you mentioned it too, on the lack of value being offered by gap insurance, with only around 6% of premiums being paid out in claims. Claire, I know you have a lot of experience in this kind of thing. Can you tell us what you've seen and maybe what it might hint at for the future?
Yeah, definitely. It's an interesting one, and I think that this probably has come about as a result of the TPR as well, because some of the providers that have decided to not pursue their applications provide gap insurance, and with a number of ones within the UK. So having seen a lot of their responses, I think one of the issues is residual vehicle values went down went up post-COVID, and they're just sort of leveling now. And I think that the percentage of premiums paid out as claims as a direct result of that in some ways, plus the inordinate amount of commissions that are paid through the dealership models. And I think that and some of those fair value assessments that I've seen again kind of meet that same point of this sort of standard template. So I've seen a lot of the responses to go back to the FCA and some FCA responses on that. And the ones that are doing well are ones that are reducing commissions to below 40%, and trying to maintain a percentage of premium payout in and around 30 to 40%, which if anybody's worked in this market, you know that's near on impossible, certainly within the timescales that the FCA have delivered. And the FCA have said have moved that timescale, which they originally said you need to implement within 3 months. They've moved that, and they're now reviewing those responses. And the ones that I've seen that are really good are people going, okay, right, we want a minimum payout, and they're starting to add extra elements of cover in order to have value. And I think one of the biggest things that's come out of this is the kind of economic elements. We're seeing this on motor insurance as well, on electric vehicles. We're seeing the economic elements of this scenario testing, because the percentage premium payout's gone down. It's gone down because the residual vehicle values have gone up because of economic issues. So I expect that we're going to see from the FCA more requirements around economic scenario testing and the impact that's overall going to have on value, which I think is an important headwind, say particularly in the motor and probably buildings space as well. And I think it's been positive to see some really good innovative suggestions from firms, but a majority are kind of trying to stick around the 50% commission and not really, and just almost justify why that premium payout. And I have had a headwind that the FCA have currently 20 enforcement notices sat in their desk ready to go to insurers over the next quarter, and it wouldn't be surprised that if a lot of those enforcement notices are going to be hitting the gap market or some of these ancillary products because of these value statements. And I've seen through the TPR and insurers going through that, the FCA again being very, very aggressive and very challenging, particularly around kind of value and what other ancillary kind of elements that can be brought into value. I think this is also one of the things the market's not been very good at. There's some USPs in some of these really great products that aren't coming through in the value assessments, and so the FCA can't see, other than just the numbers published, which we all know aren't as accurate as they could be. So there's extra value elements that need to be brought through. So I think it's going to be a very tricky time over the next quarter, and I would anticipate quite a lot of enforcement action, which I think is quite a surprise, or quite different compared to insurance generally. We normally see distributors get fined, but this is very much focused on the insurer market, which is so scary times out there at the moment to get your fair value assessments redone ASAP.
Very interesting. Thank you, Claire. And David, on that same topic then, do you think we're going to see the FCA get more interventionist and with regards to consumer duty and fair value? And do you think that's right, given that some of these products don't seem to be delivering the value that the regulator wants to see?
Yeah, I'll try and be balanced again and cover sort of both sides, but I do think there is an element of insurers have been surprised by inflation generally, and selling Gap. They weren't selling Gap expecting second-hand vehicle prices to be rocketing in the way that they did. I don't think any of us recognise that. But I think people have short memories, because I remember PPI and the PPI scandal, mis-selling scandal. The reality was that was all down to part of the distribution chain taking at times 90% of what should be a risk premium in terms of commission. So I think if you're old enough to remember that, then you should be thinking, well, if I am going to, frankly, rip off customers by taking too high commission levels, then it's going to come back and bite me. And I could expect to be paying out lots and lots of money in the future. I mean, the only good thing from the insurer's perspective with PPI is it wasn't them that were profiteering, but it's the banks that are still being hit today with multi-million pound claims there. I think one of the issues is that I mentioned previously, we're talking about principles-based regulation. So the regulator doesn't want to come out and say this is fair. So when Claire said sort of 30 to 40%, I'm thinking, that's going to be difficult to achieve. But at the other end, 6% is nonsense. None of the companies that I have ever been involved with would consider that 6% is in any way reasonable. But because we have this principles-based thing, nobody knows precisely what's right, and then that leaves sensible people to arrive at a sensible figure, but also people that maybe are a bit sharper, should we say, is a bit of a euphemism, to sort of try and justify too low a figure. If you pitch it right, you shouldn't have any problems with intervention going forward. I suppose to answer the question more directly, then yes, I think it is fair. If a product isn't presenting fair value, then you should expect intervention. So don't risk it. Plan your numbers appropriately. One little complication just to throw in on the end. I mean, we talk about add-ons as being a bad thing because sometimes the way they're sold is, add-ons to a loan. You have to buy your insurance with the bank because you're sending a loan, those sorts of things. And I know the regulator's not keen on add-ons, but when you talk about bundling covers, is it bad if one element has what on the surface in splendid isolation looks like a really, really good loss ratio, combined operating ratio, when the bulk of what's being sold is actually losing money? Because I think it's important to sort of dispel the vision of insurers being evil, money grabbing, capitalist machines. If you look at the Ernst & Young reports on motor and home, you've got combined operating ratios for the market. I think it's around about 110 for motor. So losing £10 for every £100 they write. I think it was 122% on home. So if there are things that are part of a package that are a bit more profitable, it's probably just meaning that the insurer's losing a little bit less. So I think it's about understanding the whole system, and particularly making sure that the person providing the capacity and taking the risk isn't giving too much away in terms of commission, because that's an obvious area where they could be called to account later.
Yeah,
that's such a
sorry, go on, Claire.
I think it's such a great point around, we previously seen market moving away from sort of connected contract and, the point of sale advantage, but I'm seeing the insurtech space moving very much towards embedded insurance now. And so I agree with your point, David, entirely, because let's be honest, there isn't a marketplace for these innovative products if you don't go through the aggregators. I think the aggregators are eroding value hugely, particularly for these smaller businesses, and it's trying to find that marketplace. So I don't think there's a issue with embedded insurance and firms doing that. Commissions obviously need to be considered, but obviously these firms, these retailers, these big firms that people are looking to embed within have got huge customer bases, and there's a value associated to be able to distribute, as the aggregators prove quite aggressively. There's a value to that customer base and adding on or embedding within that in that product. So I think there's a lot of discussions with the FCA that are needed just to kind of look at the market more broadly, particularly with around sort of embedded insurance and the marketplace, and whether that's serving these smaller, innovative. I see some fantastic insurtechs that are data driven, really innovative ideas around claims processes, and it's a real shame for them that they're having to go back to being vanilla with the same terms and conditions because insurers are too scared to use them, and there's no marketplace for them because it's a dirty word to be an add-on or to be embedded insurance. So it's interesting times at the moment.
It's a weird one, isn't it? Because add-ons, as I said, insurers run scared because they know the hassle they've had from the regulator previously. But bundling things together, combining things, that can provide better customer service, better understanding of the customer, and maybe even
scale. Yeah,
exactly. So I think it is about looking at things across the piece. Maybe not just because, as I say, the reason that the regulator didn't like add-ons was because of that pressure potentially that was being put on the customer. So let's be clear and say an add-on where you're pressurizing somebody to buy an expensive, overpriced product in conjunction with something else, that's bad. But an add-on where you're actually making it better for the customer, bundling things together, that's really good. And I think the other thing I didn't mention, but we mustn't just look at a single year as well. When we're looking at performance, some products will have really good years and every 3 there'll be a hurricane or massive storm. So insurers need to be able to build up a bit of a fund for those years. But again, when I say insurers need to be able to build up a bit of a fund, that's making sure it's in the risk premium, not just going out to other parts of the distribution chain.
And that's a really interesting point. Sorry to waffle on, but on that, David, because that's what's been happening on GAP. So you've got 5-year policies, and the FCA have been quite aggressive, saying, well, we don't care about it being a mature or immature book, but that's absolutely critical. And a lot of these GAP providers have gone back to explain the financial implications of viewing it in isolation on 1 year. And the FCA have been quite aggressive and quite forthright to say we don't care about that, which I think is disappointing, and I think a little naive.
Thank you. And David, you mentioned it earlier, but one of the things we've seen of late is a rise in these so-called essentials policies that have stripped back coverage for a cheaper price. And those policies, they tend to exclude areas that are usually covered as standard. So David, what are your thoughts on the value these policies offer? And is there a reputational risk here that if these exclusions aren't properly explained, which again, you touched on earlier, that even if they are, is a reputational risk to the industry here?
I agree. There is a massive reputational risk because I remember things that happened over the years in terms of alternative accommodation being a really low percentage of a content sum insured, and there people expecting to have alternative accommodation paid. And I remember government and ABI getting involved at the time of the really big storms that we had. So there's definitely a reputational risk there. I think if you are declining or not paying in full generally, it's a reputational risk. It's a problem from a consumer duty perspective as well. But I wonder whether we're being oversimplistic. So we're saying things that are usually covered. I think it would be really bad if insurers and brokers were prevented from offering lower cost solutions to their end customers. Okay, and when you look at some of the higher de facto scores, and we all, at the bigger insurers, we all fight to get as many stars as we can, that sort of thing. I mean, what are you adding? I mean, I buy my motor insurance to cover damage to the vehicle itself and any other unsuspecting road user that I collide with. Do I really care that much about belongings being nicked out of the vehicle? Probably. I mean, I don't leave things in the vehicle overnight. I mean, I grew up in a rough bit of Bristol, so maybe that's shaped me. So I think it's about understanding really what is essential. The problem is, again, coming back to cost of living crisis and maybe a bit of sort of compensation culture. There are lots of people out there who will encourage you to feel that you are being shortchanged and that you should demand to get this. But what I want is customer choice, and that customer choice needs clarity and transparency. So as long as you are pointing out really, really clearly and reinforcing it and saying it again, then I think insurers should be able to offer, whether they call it essentials or basics or whatever. There's a bit of an argument, maybe calling it basics is a bit better, a bit more honest. Of course, it doesn't work with your marketing team so much. They like things that sound a bit more sort of fluffy bunny. But it would be really, really genuinely sad if we couldn't offer varying levels of cover. So let's make sure that people know the limitations and that we give them low cost choice. Because the other option is people will stop buying insurance, and that would be far worse, for them as well as the market generally.
Yeah, thanks, David. Well, we are rushing. Sorry, not rushing through it. It's taking us longer than we thought to get through all the questions. So we might have to skip on in a minute. But Claire, just quickly, do you have any further thoughts on that around kind of when an insurer is looking at developing a new policy, what they need to consider from a value perspective?
So yeah, so I think there's, from if you're doing the sort of essentials products, just follow on to David's point, was that actually this is where positive friction needs to come in and get customers to ask more around their demands and needs and what they want from a product, and be able to flex the opportunities, which I'm seeing great stuff come through on InsurTech, is them to be able to flex and see the price. And I know sometimes on motor insurance that gets you anti-selected against, but I think that kind of positive friction to allow people to choose what they want from those products, and again, I'd be able to add in
and I know we moved away from that because of aggregators and the way the aggregators have informed the products. But I think going back to that base and build and pricing each element and allowing customers to flex would be a, a highly smart thing to do at this stage.
Right. Okay. Thank you. One thing that's going to lead us nicely into technology, which was the next topic I wanted to explore, was another question we've had coming in about those high upheld rates at the Ombudsman. With one of our viewers saying this is a massive failing on the part of insurers, and can or will AI actually help insurers to escape the process trap that I think David outlined earlier. So David, I guess I should come to you for that one.
Escape the process trap. I mean, it's weird, because when you think of technology generally, you think of it hard coding the process. I think the positive would be that AI should be able to be more skilled. So rather than a simple sort of yes/no binary, being able to make the decisions of, for instance, an experienced claims handler. I mean, that would be the goal. So I suppose I would be cautiously optimistic. Certainly technology can play a role in terms of analysis, in terms of being able to look for trends. Machine learning, even before full-on AI, can help there. But so yes, if used appropriately, but a risk that you sort of hard code things too much, and computer says no, isn't what anybody wants to hear.
Yeah, and Claire, on that point, actually thinking about it with things like machine learning and generative AI, around transparency really and how they can work, that could potentially be an issue, couldn't it? Particularly when talking to regulators. Do you see a big kind of regulatory risk around this?
I see a huge regulatory risk because I've worked with firms doing sort of underwriting audits and looking at TPAs, and there's a real governance issue there of boards understanding what that does and understand the implications of that. We've seen in the US life insurance provider being sued over the technology used to opine on claims. So I think it's a huge issue, and I think at risk, and I think insurers need to be the ones to put the governance in place. There's a fantastic firm called For Humanity that are working on an audit, not-for-profit audit framework for AI to help inform people about what they should be considering, but making sure that boards and those governance controls are in place. And I think that it's definitely an emerging headwind. And I think a lot of TPAs and distributors will be introducing these AIs, and insurers have no idea, and ultimately they end up being accountable for these decisions. So I think it's definitely something people need to consider. And if you haven't already, have a look at this For Humanity, because I think there's a really good framework for how to implement it safely.
Thanks. Okay. And sticking to digital experiences, AXA recently launched its new digital brand Moja, and it's one of many examples of insurers introducing kind of digital-only experiences. David, do you think technology is helping, or is it more of a hindrance, given that many people want to speak to a real person, particularly when it comes to something like making a claim, which can be such a stressful and emotional experience for some people?
Yeah, I think Moja's been a great success, but I think you need to understand one of the reasons for launching it. I mean, it wasn't to save costs; it was to target a whole new market that maybe wasn't thinking about insurance. Digital natives. You've got to be looking to the future. So it was focused from the right perspective, but using technology. Again, just to play devil's advocate, though, you say lots of people want to speak to a human being. Do they? I mean, certainly in terms of the sales process, Moja's proven that they don't. They want a really slick, efficient service. They're used to doing everything else online. And therefore, why wouldn't they want their insurance provider to be transacting them with that way? And I think we're in a bit of a halfway house at this point in time, because insurers, including AXA with Moja, whilst they're saying digital only, they're still really, really keen to give the customer the option to speak to a human being if they need to. And I think going forward, again, playing devil's advocate, they need to be braver. We know that there is a cost involved in speaking to a human being. So are you depriving a customer's right to save some money by choosing to have a real only machine online interactive product? And again, with AI coming in and being better and better, there will be more things that can be done. So I think maybe the time isn't quite right at this point in time But, you know, it's good that people are using technology more. It's good that they're recognizing people want to interact in different ways. But at some point in time, I think people need to be issuing products where, again, full transparency, they say, this is great, you get your own person looking after you, concierge, all this, and this is cheaper because you're going to be transacting online.
Okay. And Graham, what do you think customers are looking for when it comes to the use of technology? Is it just all about offering choice, do you think?
So I've got two answers to this. One, so I'm obviously an industry outsider. So from my perspective, my view on this personally is technology is there to play a supporting role. It's there to improve processes. It's there to operate alongside existing processes and just try and make things better. If I put my Trustpilot hat on and I read what people are saying, they just want cheaper premiums, and that is it. And you mentioned Mojo earlier. They're a really good example. So everyone knows what their business model is. And if you look at their existence on Trustpilot, they've got over 1,500 reviews at 4.3 out of 5. So the overwhelming majority of people are saying, great, these guys are really, really good. But if you actually delve into what people are saying, it is overwhelmingly positive, solely about price. And this harks back to what I was originally saying about when you actually ask for a review. And it looks like what Mojo are doing is they're saying, hey, look, we'll sell you a policy. You can sign up for this policy, and then we'd like you to review them. And people just go, well, great, yeah, this is a really good price. So I'm very, very happy. But then if you look at the slightly negative sentiment that they're getting, it is about the admin process. So when people need to change like a named driver on a policy, when people need to, oh, I spelled my name wrong, I need to do this. And then it's about, oh, right, okay, I can't just do that. I can't just pick up the phone and have it done. I've got to go through this whole process for it. And that's when things start to go a little bit out of kilter. So there always has to be a compromise. But yeah, I would say from a technology perspective, I mean, some of the aspects of technology that supports the insurance industry are now pretty much mandatory, like mobile apps, chatbots. Nobody questions them anymore. They've been around for ages. They're here to stay. But in future technology, I would hope it's just going to streamline that process for consumers and make people's lives easier. Whether people would say positive sentiments about that, I don't know, because from what I'm seeing at the moment, it is pretty much all focused on the actual price.
Thank you. And we're almost out of time. I've literally only got about a minute left. So just apologies to people that have submitted questions that we haven't got round to answering. I think we could have gone on for about 2 hours here with the questions that are coming in. One comment that I just thought I'd just talk about is one of our watchers, Catherine Carey from Consumer Intelligence, has just put in there that a quote, but it's a stat which is quite useful based on what we were talking about just a minute ago, where she says that according to some consumer intelligence research from September this year, over 64% of consumers say they want to talk to a human when making a claim. So I just thought I'd throw that in there as an interesting stat. Andy Woodbridge has asked a question about something that I think Claire, you mentioned aggregators earlier. The question here, I don't know if you can maybe answer this very quickly, is are the FCA reviewing aggregator fees and a fair value? And should the charges be disclosed to the customer by the insurer or the broker?
Not yet, but I'm working on it. It's one of my passion projects. So as far as I'm aware, no. I've had some discussions around it, and I think that I'm pushing with the trade bodies as well to have this more transparent and to be looking at it more proportionately. Although I would say I am hearing more broadly across the market that aggregators are looking in it themselves, given the switching reduction that we're starting to see, and looking at their models and whether there's a place for 5 aggregators in the market and what their future model is going to look like. So watch this space is what I'd say.
Okay, thank you. And that's probably a good point to end things. So many thanks once again to David, Claire and Graham for joining us today. Look out for our customer experience report. It will be available to download from our website. It should be later this week. And we'll be sending it to all of those people who've registered for today's webinar via our email newsletter, which the next edition will be coming out early next month. Insurance Data Lab subscribers can see our ratings for every provider that the research that Matt talked about earlier is based on, and compare the performance of individual companies across much of the data that underpins the report, including things like the areas kind of data we talked about earlier, Ombudsman and FCA complaints data, Trustpilot trust scores, fairer finance customer experience scores, and a lot of other stuff, which is all on our platform. If you'd like a free trial or would just like to find out more, feel free to contact me at dan@insurancedatelab.com. So that is pretty much a wrap for Insurance Data Lab this year. From Matt and I, thank you for watching. Have a great Christmas and New Year, and goodbye for now.